Hello, everyone. Today on the final bar, we'll do our normal Monday routine, looking at the market from three directions: top-down macro, bottom-up stock picking, sector rotation in the middle. Today's show, and really today's market, really has a mix of all three. You can see the bottom-up exercise, the value in finding names that are working, because even on a day when the S&P finished in the red, the NASDAQ down heavily, there are stocks that are doing just fine, breaking to new all-time highs. Let's separate what's working from what isn't and focus on the most important charts. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down market activity using the power of stock charts, using our ability to visualize investor behavior, decision-making, psychology, fear and greed, all those emotions that translate themselves, manifest themselves in the form of asset prices, stock prices. And really what we've seen with this market, we've talked about the rotation, the leadership rotation, and a day like this sort of summarizes a lot of key themes that I think we've been struggling with or talking about for quite a while. The big bearish divergences, the distribution that we've seen in technology, in the FANG stocks, in semiconductors down big again today. The weight of the NASDAQ on the overall market, and can the market hold up? Given that scenario with mega cap tech and consumer names struggling so much, with 4 out of the 6 FANMAG stocks testing their 200-day or having already broken below their 200-day moving average. So what you can see on a day like today is that stocks, individual names, can certainly hold up okay. And the question is there enough distribution, enough people in passive products that lose faith in equities and pull their assets out, that sort of drives everything a little bit lower? That's a potential scenario that could evolve. That's how the market could move materially lower from here. But let's focus on the individual charts, where we're certainly seeing some key stocks holding up just fine. Now, having said that, let's just point out some of the guests we have coming through the show. We had some great guests last week. Ari Wald on Thursday, had a lot of fun talking with him, with Jonathan Krinsky, with Jeff Hughes last week. This week, more of the same. On Tuesday, Jesse Felder from the Felder Report. On Wednesday, Dana Lyons from Lyons Fund Management. And then on Thursday, the 11th, Willie Delwich, strategist at All Star Charts. Also, to remind you, on Monday, March 22nd, we will be featuring a special event, Chart Madness. This is a March Madness theme stock picking exercise. 4 of us will have our brackets. We will fill them out. We will walk through all the matchups and declare our final 4, our best opportunities that we see through this list. You're welcome to follow along with us as we pick, and let's see how those picks do over the coming weeks and month. That's coming up on March 22nd. So as we recap these markets again, on Monday, we do a 3-pronged approach. We start with the big picture, then we'll go through sectors, then we'll go through stocks. And I think the chart of the S&P, just this little preview chart from Friday to today, shows you really what is happening here. Last week was pretty difficult, but the second half of Friday was very resilient. You saw strength going into the close as stocks gained quite a good amount, and didn't give that back going into the close. That last hour, which tends to be a lot of institutions, a lot of ETF rebalancing and such, just continued to go higher. Today, it felt like just a continuation of that trend as the S&P opened, continued push higher up to the 3880 level around lunchtime. From there, though, you could say that it gave back a lot of those gains. Now, if you look at the NASDAQ chart, you can see why the S&P itself has been pulled down. It's difficult for the S&P, this broad index of large and mid-cap U.S. stocks with a big weighting in technology and consumer and communication services stocks. It's difficult if the NASDAQ is doing this, just going steadily lower all day, for the S&P to hold up and remain in the green. That's sort of what happened. If you look at the Dow, which is less weighted towards some of those sectors and more weighted to things like energy and financials and others, you can see that the Dow actually finished positive for the day. So you have this sort of mixed bag of the Dow going higher, the NASDAQ going lower, and the S&P in the end netting out negative. The small cap index up almost 2% today, while the S&P is down 0.5%. So what this tells you, is it's essentially a stock pickers market in the fact that stocks like Discovery and Viacom and Disney and Ulta and a lot of banks, regional banks, energy companies, which actually gave some back today, industrial stocks, material stocks, all just continuing in an uptrend, pretty decent, right? Pretty strong uptrend. While others, if you look at semiconductors, the world feels like it's going to ending. If you look at Peloton and Zoom and Ulta, or sorry, not Ulta, Roku, you can see those are all breaking down through support. So you have this sort of bifurcation, a clear differentiation between what's working and what isn't. The challenge I see for this market right now, as I mentioned in the introduction, is if you have enough of technology going lower, you have enough people that have clearly been in passive products and ETFs that have a huge weight in some of these big technology names, the worse that those do and the worse those returns are. I don't know if they all as a group pull out of those passive products and start actively picking energy names or financial stocks and get into Huntington Banks and KeyBank. I think they pull their money out of equities or go into cash or something. And that's what I think could cause further downside in stocks. When people sort of have this disbelief, which is the phase we're in now, when we start to buy into the fact that the market may be going lower, that's where something can snowball lower. I've talked to some people who don't understand how the market could go lower from here, and that's what it is. Right now, certain stocks are working, and I would continue to lean into what's working and lean away from what's not. Let's check on some of the other themes today. The VIX back up just a little bit, around 26. Looking at bond markets, the TLT was lower through the course of the day, really accelerated going into the close. 10-year yields back up around 1.6%. Commodities down across the board, while energy has been a really good sector up until now. A lot of energy stocks struggled a bit today with oil prices down about 2% in the form of the USO. Gold as well. And so when we talk about the concerns about inflation, what you would normally see if people are worried about inflation is gold to just start to go higher. And we just have not seen that. We've seen gold in an established downturn. We've seen gold stocks, the GDX, the XAU, inconsistent downtrends. Those have not bottomed out yet. So you're not seeing a rise in, sort of the most popular inflation hedge, which would be something like gold. So we're not seeing that yet. Cryptocurrencies overall a bit mixed, but net positive with Bitcoin up about 1%. Chainlink out of the top 10 that we follow on the front page up the most. Let's focus on a chart of the S&P here. Again, on Friday's show, we focused a lot on the long-term equity case. So if you missed that, I'd encourage you to go back on Friday. We spent a lot of time on the Mindful Investor Live chart list, looked at the weekly model, which has been negative now, has been bearish on the short term and medium term for the last 2 weeks, starting not last Friday, but the Friday before that. So reaffirm that on Friday's close. The daily chart as well, we talked a lot about, and just to remind us, we have the scenario where the S&P pulled back to the 50-day moving average, bounced off, now coming down, and we're sort of in that rounding error away from the 3,700 level. And the way that I've described it in recent weeks and recent months has been you have sort of 4 steps to indicate that that the S&P is going from bullish mode to bearish mode. Number one, you get some bearish divergences, which we've had, and on the S&P for sure, but on individual groups, the semiconductors bearish divergence, I think, was the most obvious glaring signal of a long-term potential top in those sort of growth names. Step 2, we need to break down through some trend lines. We've done that a couple times now. We broke down through the pink trend line, which is taking the October low and the December and January lows. We also have broken down through a trend line using that next low in January. We've broken through all of those. We now have to break down through the 50-day moving average, which we are in the process of doing, arguably. We bounced down through there on Thursday, closed back above Friday. We once again have closed right at the 50-day, which means 3 out of the last 7 trading sessions we have closed almost exactly on the 50-day moving average. That is a market in transition, if I've seen it. The final step to indicate a downside reversal would be a close below 3,700. That we have not seen yet, but I think that opens up the door to increased risk of further downside. And more as I'm looking at a 3,500, which is a 61.8% retracement level, and the 200-day moving average, I think would be the next area to look at down there. Just very briefly, the only other things I would say is a lot of the themes we have been talking about up until through today continuing. So gold continuing to be in a downtrend. It's right at that congestion area. Gold is now at its lows from last spring into last summer. It's a pretty reasonable point where you'd expect gold and gold stocks to bottom out, but we have not seen that actually play out yet. And silver as well has pulled back a good amount there. The last thing I would show you is just the 10-year yield, which continues to go higher. The shape of the yield curve continuing to steepen. The 10-year yield now at a 38.2% retracement level of the 2018 peak to the 2020 low. Is that a time when bonds could potentially bottom out and bounce up a bit, making yields go down? Absolutely. And I could see the case for a pullback in yields, a downward move in interest rates, a pullback in financial stocks, which have had an incredible run, but we have not seen it yet so far. Based on today, the foot is still on the accelerator. Our next segment is looking at sectors. We've talked about the big picture, looked at some of the overall themes. Let's look at some sector rotation and see how the sectors have evolved. We'll start with the weekly RRG. And as always, if you're not familiar with this methodology, Julius DeKempener designed this years ago. We're fortunate to have him as a StockCharts contributor. His show, Sector Spotlight, does a great job of using and describing this methodology. So check out his work if you're not familiar with this, his blog as well. But essentially, sectors and whatever asset classes you put on here tend to follow a clockwise motion. Up and to the right is strong with improving momentum. Down and to the left is weakening with weakening momentum, and everything else is sort of in a transition phase from a strong uptrend to weak downtrend. And what you can see here is energy has really reverted higher in the last couple of weeks. Financials number two, those are the two, and then it's everything else. And really energy, the outlier as the strongest long-term trend, financial second, communication services third. And again, communication services is interesting because you have things like Facebook, which have struggled, but you also have things like Viacom and Discovery, which are just blowing out to new all-time highs consistently. So sort of a mix of the media names, the entertainment names that are working, and other things like fixed line telecoms, which overall have been relatively weak. Things like some of the internet stocks, which haven't been as powerful, but the strength in the media names really keeping that sector above water pretty nicely. Interesting to note that communication services, technology, and consumer discretionary were sort of all in the same place a couple weeks ago. And now we've seen a clear differentiation with one of those three sectors now firmly in the leading quadrant, the other two heading southwest, and one of them, consumer discretionary, now in the lagging quadrant. Now, it's a bit misleading because these are all obviously the cap-weighted sector ETFs. So the largest stocks in those sectors a lot of time can have an outsized weight. And when you think about consumer discretionary, Amazon is the number one stock in there by far. It's probably 25%, I would guess, of the weight of the XOI is just this one stock. Now, this is a stock that is back below its 200-day moving average. It's the first of the six FanMag stocks to do so. It's now testing its support level from last September, bounced off of it. It tested it on Friday with this hammer candle. Instead of rallying off of the hammer candle today, it actually went lower. I'll show you this in ACP. It might be a good way to show what I've done here. So when we look at Amazon, here's a little zoom into the candle chart here in the lower left. You can see this in the last couple of weeks has been distributive. This is a hammer candle, which you might actually call a dragonfly doji. They're digging into your candle pattern knowledge base for the CMT exam. This is where you have an open and close very close to each other, a very low, a very light or limited upper shadow, and a long lower shadow. That's a reversal pattern. Think of it as a hammer hammering out a bottom, a big downtrend. You open at one point, you trade lower, but by the close, you've regained those highs. And then it usually ends up being a nice bounce. We bounced today, and earlier in the day, it looked like, okay, that hammer candle was perfect. We're going to rally on. But look, we actually closed about halfway down through Friday's range, and we closed down at the lows of the day. Now, if you're a stickler for candle patterns, you need to go below the low of that hammer candle to invalidate it and suggest that it was an incorrect pattern. But overall, I would say anytime you have a signal and then you don't really get the reaction the next day that you would expect, and that's what I think you've seen here with Amazon, hammer candles that indicate growth stocks are going to work and we're sort of back to the normal uptrend. Let's buy the bounce. It didn't really work today. It worked in the morning, but sort of gave all of that back by the end of the day. I think that speaks more to some real long-term weakness on some of these FanMag charts that we may not have expected otherwise after Friday's close. Felt a little more encouraging than today's trading might tell you. With any of these charts, you really would need to break down below the close from September low. That's around 28.75. That was the low from Friday. I think a close below there really opens the door to much further downside on Amazon. So when the biggest stock in the sector, a quarter of the ETF is doing that. That is why this sector is going down into the lagging quadrant, which is essentially what's happened. Same thing with technology, not as much of one particular name driving it, but but a lot of stocks showing some weakness. When I think about technology, I'm immediately thinking of the chart of semiconductors. Thursday of last week was pretty negative. This we had a big down day. Again, it had a hammer candle, just like Amazon did on Friday. And all of a sudden it felt like, okay, we've actually closed higher on Friday, a hammer candle. I might suggest a nice bounce. Today, we invalidated that with a close back at the lows of the day with the SMH, one of the more common or more frequently used semiconductor ETFs, down about 5.5%. In my opinion, this really validates, it completes this transition from a bullish phase, ending in a bearish divergence, and now breaking to a new swing lower. Below the 50-day, we're below that low from January, and we followed through with today's lower close. Overall, I think this sort of downtrend has further to go, and I think there's more of an unwind that needs to happen. I think people are still in the disbelief phase of some of these pullbacks, with these charts really starting to look a little more negative, or a lot more negative than positive. So with a chart like semiconductors, I would certainly be lightening up and thinking about your risk assessment, focusing on stops and making sure that you manage cash effectively, because there's certainly an increased risk when we break support and we break moving averages. There's always an increased risk of the risk of the market or the chart moving materially lower. Now, having said that, how come the whole market isn't down dramatically? Well, it's something like this: the XLF making a new 52-week closing high today, making a new 12-month relative high today. Charts are working out there. The KRE making a new, a new long-term high, a new one-year high. The industrial sector XLI making a new high. So there are plenty of sectors that are actually holding up really well and breaking higher. I think now more than ever, you really need to be focusing on, number one, the downside of a big passive product like the spiders, which overall, when the markets are fine and it's a healthy uptrend, make a ton of sense because it's not something you have to worry too much about. But you have a scenario like this where there's a real differentiation, and some charts are working and some charts are not. I would be finding ways to lean into the charts that are working. And right now, sort of those late cyclicals, it's energy, it's especially today, it's financials, it's industrials, it's materials, it's sort of the reopening trade or the infrastructure trade, I might want to call it, that's continuing to materialize here on a Monday. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we review the charts together and focus on the market's message as it evolves. As a reminder, we love to hear from you, particularly questions that are coming up as you're analyzing charts. I mean, it has been an uncertain year and uncertain times, but now more than ever, if we can help point you in the right direction in terms of market analysis, technical analysis, particular charts, tickers, just let us know. An email would be great. thefinalbar@stockcharts.com is our email. On Twitter, @finalbarsctv. On our YouTube channel, just put a comment below the video that you're watching. We gather all of those, and we hope to answer one of your questions on the air on tomorrow's show. Also, as a reminder, the new StockCharts TV website and app are all released, called StockCharts TV on Demand. Just go to stockchartstv.com to set up your free account. We're also on all the app stores. All you need is an email address to sign up for free, and you can access all of our content. Really excited with how the team has presented our hosts and their great expertise. All the great content is accessible on all of your devices as of now. Our next segment is called Shifting Stocks. This is where we focus on individual names. So we've talked about the big picture, this market in rotation. We've talked about sectors and the leadership rotation away from the growth trade into really the value trade, but it's more than that, right? As Ari Wald and I were talking about last Thursday, it's not really the value trade as much as it is the high beta trade. These are mid cap, small cap names in certain sectors really emerging. And if you look at the regional banks index, you can see a group that's just working very, very well, and a group that I think a lot of people have mentally written off because it's had a stretch multiple years of not doing as well on a relative basis. Rising rates are making that a much more compelling place to be. But I did want to focus to start with on what's really dragging the market down today. earlier in the day when I see the Dow up, I see the S&P up, and I see the NASDAQ down, and I see that getting worse, I don't feel great about where the market overall, the health of the market, because that's a huge rotation. And these aren't just some names that are rotating lower. These are big benchmark names, which a lot of investors, if they're in any passive product, have a ton of exposure to. So these stocks doing well does not boost people's confidence in stocks. My concern is that drags everything down with it. Even though we've not seen that yet, we've seen other sectors hold up just fine. The question is this enough of a weight on the S&P to hold things down? This chart looks at the New York FANG Plus index at the top, the relative strength of this index versus the S&P. You can see since mid-February, we have gone from a new relative high for the last 12 months to making a new swing low and continuing to accelerate to the downside. The reason is because most of these names are at or near their 200-day moving average. The first to break down was Amazon, which is here, breaking down through its 200-day moving average really a couple weeks ago now, but really following through last week and continuing to close lower today, making a new closing low for the stretch and testing that support level from last September. Netflix as well closed below its 200-day moving average today for the first time since back here. This is back in March of last year. This is the March low. That was the last time that it was below its 200-day moving average. That's how far this trend has reverted from an uptrend to a downtrend. Others are not there. So Alphabet, plenty of distance away from it. Microsoft, plenty of room between price and its 200-day. Apple, really close to it. And Facebook back below. So now we have 3 of the 6 FanMag stocks closing below their 200-day moving average. One other testing that very soon, potentially Apple, and the other 2 still holding up okay. So you've seen this transition as more and more of these names have rotated from a bullish phase to a bearish phase. This is why the NASDAQ looks so bad on a relative basis. This is why a lot of the stocks that had been leadership really up through not too long ago are rolling over. But a lot of these stocks, if you look at the FanMag stocks, most of them topped out back here, back in sort of that, sort of August, September of last year range. A couple other, couple outliers, Microsoft and Google made new highs, but the rest of them really have been struggling since then. What else can we look at as we review some of the charts? I mentioned semiconductors. We don't have to bring up all of these, but the SMH is a great proxy for that. Applied Materials, which again, these are stocks that bounced pretty good on Friday, and it was, as I was looking at them over the weekend, I was thinking, all right, that could be a nice bounce, and a lot of these are hammer patterns, which are essentially bottoming patterns. That's a short-term reversal pattern. Almost all of those were negated today as these stocks close back. Finish the session at its lows, really undercut or right at the low from Friday. So really eliminates that as a potential upswing. So, really in technology, I'm seeing a lot of charts that are not exciting me too much. Other things that don't excite me as much are stocks that are breaking down of support levels. And we'll look at some of these work from home stocks that are struggling mightily. Zoom now below its 200-day moving average. That happened last week, now closing below its low from January. That happened really today. As of Friday, again, I'm looking at this over the weekend. I'm saying, all right, we're holding these levels. We're holding that support level. And it's not a bad bounce. It's actually, nearing an oversold condition and its previous low. But today we actually broke below it on heavy selling. That doesn't feel super encouraging to me. Peloton, same thing. This is actually at its 200-day moving average, has not closed below it. That would be for the first time because it's a relatively new listing, but overall, something to watch. Roku, not near its 200-day, but broke below its 50-day, and now and also has broken below its low from last from January. So these are sort of the stocks that had really nice runs. A lot of these showed divergences. A lot of them now following through to the downside, really, falling heavily today. And again, I'm concerned about the ability of some of these stocks to maintain or hold some of those key levels. What is working then? What's actually emerging on the upside? Airlines actually not doing too badly. So you have this whole sort of reopening the economy trade. Obviously, the big stimulus, bill passing over the weekend. I think encouraging, prospects of infrastructure spending. So industrials, materials, all sort of feeling the love there. Airlines actually going up. The airlines index up almost 5% today. So you have a situation where semiconductors down 5%, airlines up 5%. That shows you, again, this bifurcation. What's working and what's not are sort of polar opposites. There's not a lot sort of in the middle. It's sort of things are up big or they're down big, I feel like. But it's not just focused on airlines. There are other names that are working just fine. And as always, I learned in my Fidelity days to screen for stocks making new highs, screen for stocks making new lows, think about whether I own the things on the new highs list, and if not, why not? And have a good reason why you're not justified by owning stocks that are working. Something like Ulta Beauty making a new 52-week high again today, a new closing high, up almost 4% today. And it's not just that though, it's this entire basing pattern. A lot of these have sort of cup and handle patterns, these rounded bottoms, sort of a shallower pullback from resistance, and now breaking above and holding those levels of breakout. The 50-day is right about at that breakout point around 305, 310. I think that's an important level as long as it stays above that. Trend is pretty good. Disney, a nice bounce higher. The news out of California that they'll reopen theme parks, I think starting April 1st on a limited basis. That's it's a nice vote of confidence. I was interviewed earlier today on another media outlet and was asked in particular about Disney. And my comment was the bounce today, certainly you can attribute that to the news that the theme parks begin the process of reopening. That's certainly encouraging. But the story of Disney is not today and the bounce on theme parks reopening. The relative strength of Disney is really about Disney Plus, and a company that has been able to be have a robust return profile in one of its most visible, obvious parts of its business, not being completely shuttered. Right, theme parks are closed, and the stock continuing to close higher and higher, making new 52-week highs consistently over the last couple of months. I think that's the story. I think this is the latest up move in a series of up moves. And that's when we think about focusing on the trends, focusing on what's working and what's not. I think Disney is a great example of that. This news today that makes the stock bounce to new highs is just the latest of a series of steps. The trend has been in place for long before today. Now, also, when we talked about, media stocks, again, Viacom up huge today. Discovery up huge again today. Viacom was really the outlier, moving higher today on the Paramount Plus news. But these are stocks that have clearly made a decent effort on the streaming media front. These are growing beautifully, having good subscriber numbers, good prospects for growth, and the stocks are continuing to reward it. It is difficult to chase some of these names that have rallied so hard. Having said that, though, there are plenty of examples on the chart of Discovery looking back over the last 3 months where you could ask me that same thing. Is this too late? Did I miss it? And what we're finding on a lot of these stocks is they continue to work, continue to be in well-established uptrends. We need to wrap the show, go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is Dow theory. Again, you can tell by my language and how I'm describing this market. I actually got pushback on Friday for being a little too bearish, which I guess I'll take that as a point of pride. I guess my cautionary instincts are coming out loud and clear. That's good. I am normally a very optimistic person. Believe me when I tell you that. I'm pretty bouncy and happy about things. But what I see on the market right now is I see, we've seen divergences, we've seen internal weakness, we've seen breadth not confirm previous highs. We've seen the semiconductor chart, which I've talked about a number of times, seems like a glaring, certainly a signaling the end of that large cap growth trade, at least for now. And we're seeing all that materialize. The question is, are enough things emerging that the markets themselves are holding up? At this point, I'm very happy looking for charts that are working. And even if the S&P is down, I think passive products could struggle a bit, but individual names could continue to work. And I think it's a great time to be using charts to focus on stocks that are working. But the news for the broad macro environment is not all negative. It's not all scary, and it's not all bad. The cumulative advanced decline lines are all making new highs, as Ari and I were talking about, Ari Wald and I were talking about last week. This is the Dow theory, looking at the Dow Industrials and the Dow Transports. Dow Transports made a new high today. The industrials came off a little bit off of making a new swing high, but overall, they're both in pretty decent patterns. Most recently, they're making higher highs and higher lows. When that changes, then we start thinking about real downside potential. It's not changing yet. Chart number 2 is Roku. I mentioned some of those stocks like Zoom, Peloton, Roku. These are all stocks that have broken down through key levels. Roku in particular is testing Fibonacci support as well as the low from the end of last year. I'd be watching that very closely if I were there. Third is the regional banks ETF making new high, the relative strength making new highs. It's the 10-year yield. That's the chart that you were investing in if you're buying something like regional banks. Go back for the last couple of years. The relative strength is literally the chart of the 10-year. That continues higher. Those are good places to be. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.